that saying, nothing in life is certain except death and taxes. Well, for the past few years, I would add one more thing: confusion around mortgage interest deductions. Every tax season, client would sit down with me and ask, Mia, can I still deduct PMI? Will my 100K mortgage okay? Are the rules about to change again? And honestly, the answer has always been, it depends on what Congress decides. But that finally changed in July 2025 when Congress passed the Big Beautiful Tax Act. So it locked in permanent rule for mortgage interest. So now no more waiting and guessing. So for homeowner, landlord, and investor, we can actually plan ahead with clarity. Let's go through what the law says, how it affects real family and landlords that I work with, and then I will give you some bonus tax planning strategies where you can tie it into other parts of the new tax law, so you are not going just compliant, but you're gonna be able to save some money. So what changed? So the $750,000 cap on acquisition debt is permanent, which means if you do marriage filing separately, you can only get half of that, so $375K. Owner loans from before December 15, 2017 are still grandfathered at $1 million cap. Home equity interest is out unless the money is used to buy, build, or improve the property. So acquisition debt, right? That's what it is. If you do home equity, the home acquisition debt part is still deductible. And starting with your 2026 tax return, PMI is treated as mortgage interest. So no more temporary extension, no AGI phase out for this. So beginning with 2026 returns, the rules are set in stone. So let me share a few stories with you. One couple, we will call them David and Maria, bought in California with an $800K mortgage. So for years, they worried how much is deductible this time. So now it's clear. Interest on the first $750K counts. The $50,000 left over doesn't, so just that's it. Let's talk another example. Another client, Sophia, is a single mom in Honolulu, has been paying PMI for years. So some years she got to deduct it, some years she didn't. So starting in 2026, her PMI is permanently part of her interest deduction as long as she itemizes. Another example, Ken and Lisa in Seattle has a mortgage from 2016, just under $1 million. So they was afraid they would lose their grandfather status when the TCJA, like Tax Cut and Job Act rules, was set to expire. But now they are safe. So as long as they didn't refinance into a bigger loan, their $1 million cap continues. And finally, Mark, a landlord in Texas, he refinanced a rental for $500K. So he thought the $750 cap applied to him too, but the rental interest goes on Schedule E, which is separate from the personal cap, so he gets to deduct all of it. So how do you make the most of this? How do we plan, right? That's the most important of tax, just not doing your tax return and being compliant. But the biggest advantage of tax is when you can do planning and actually save yourself money this year or in the future years. So with number one, you want to watch your refinance balance. If you refinance and push your loan over $750K, so that extra piece will give you deductible interest. But knowing this is personal cap, right? So this is for your home, not your investment properties. Number two, know when to itemize. So with PMI counted as interest now, so more folks might find itemizing pays off. So compare your standard deduction to your mortgage plus your SOT limit and charitable deductions. Third, you want to separate your personal from rentals. So keep loans for your home separate from loans for your rentals or for business. So personal rules have cap, rentals do not. Fourth, you want to protect your grandfather loan. If you got pre-2017 debt under $1 million cap, You want to think twice before refinancing. You might give up that benefit. Number 5, you want to track points and loan fees. Some are deductible right away, some over the life of the loan, saving your closing disclosure paperwork when it comes to handy when you do your tax or when you employ a tax professional to do it for you. So here some bonus tax tips that I want to share with you, especially on the Big Beautiful Tax Act. The mortgage deduction doesn't exist in a vacuum. You can tie it into other parts of the Big Beautiful Tax Bill for even bigger savings. So pair it with the SOAP deductions. Remember that SOAP cap is now $40,000 indexed, but not below $10,000 like before anymore. So if you live in a high tax state, combining SOAP with your mortgage interest might make itemized worth it. You also want to stack it with the senior deduction. So if you are 65 and older, there's now a $6,000 senior deduction combined with your mortgage interest and SOAP, and you might see a big bump in your deduction. Another thing is charitable planning. So if you just shy of itemizing, which means you are really close to the itemizing threshold compared to standard deduction, so you can also push a little nudge to it and by bunching charitable donation into 1 year alongside your mortgage interest, that can push you over the line to make standard deduction worth it for you. Another point is you want to use retirement contribution. So for people paying PMI, lowering your AGI with retirement or HSA contribution doesn't matter as much anymore since PMI no longer phased out, but lowering AGI can still help with other credits and deductions. With landlords, you want to tie in bonus depreciation. The Big Beautiful Tax Act restores 100% bonus depreciation for property acquired after January 19, 2025. If you are a landlord financing improvements, your mortgage interest is deductible on Schedule E, and those improvements might also qualify for immediate write-off. So that will benefit, right? QBI deduction. So starting in 2026, the qualified business income deduction is permanent. If your rental rises to the level of a trade or business, you can deduct 20% of that net rental income after interest. So combining QBI with mortgage interest make rental ownership even more tax efficient. Another point is energy efficient. So if you refinance or improve your home in 2025, remember that many energy credits like solar panels or efficient window end after 2025. If you are rebuilding or refinancing, it might be the year to bundle in the upgrades for tax credit. I had a client, Rachel, who refinanced in 2022 at $740,000. She called me and worried this year because she wanted to do a cash out refi and add $50,000 for renovation. I explained that under the new permanent rules, that extra $50,000 would push her over the $750,000 cap, and the interest on that portion won't be deductible unless you could tie it directly to improving the property. So by planning ahead, she decided to keep her balance under $750,000 and use saving for the rest. So that saved her some headaches later. Another example I want to share with you is Jason and Emily in New Jersey. They pay around $15,000 in property taxes plus $20,000 in mortgage interest. So under the old $10,000 SOAP cap, they rarely itemized. Now with the SOAP cap at $40,000 and permanent mortgage interest rule, they can itemize every year. They can even pair with their charitable giving to maximize deduction. So to wrap up, with the Big Beautiful Tax Act, which finally gave us some stability so we can plan ahead of this, the $750,000 cap is permanent. The PMI is treated as interest starting in 2026. The older 10 million loans stay grandfathered in, and home equity interest is only deductible if it's used to buy, build, or improve. The best part is you can now build tax strategy that combine these rules with other provisions in the bill, like the SOC cap, senior deduction, QBI, and bonus depreciation. This isn't just about knowing the rules, it's about using them all together. For my clients, this means peace of mind. David and Maria finally know where they can stand with their 800K mortgage. Sophia in Honolulu can count in her PMI deduction. Ken and Lisa keep their grandfather loan. And Mark can deduct all of his rental interest. Rachel can avoid a big, costly refinance mistake. And Jason and Emily in New Jersey can finally itemize again. These are real family and landlords, and the law now give them and you certainty. So remember, this is for educational purpose only. It's not personal advice. Your situation is unique. So check with your tax pro before you make a move. So if this helped, hit the like, subscribe button, and then share with someone that is navigating mortgages. And don't miss the other video in the series, like how the new SOC rules work, the senior deduction, or the big changes for casualty losses. All of these fit together, and knowing how to use them in combination is where the real planning happens. Thanks for watching, and I will see you in the next beautiful Tax Act update.